Walk us through the potential to get to 2.05%.
It's simple, Alex. The bond market is in a bull market. It is essentially avenging the calls for the dead bond bull last year, right? And what we've seen happen now is simply a retracement to the equilibrium of the trend from 1.31% to 3.25%.
Is this the chart we're looking at?
So
for that?
we're at the middle of this entire range. So the question becomes, how much lower can yields really go? And when you use technical analysis, you look at the major turning points in the prior trend, that being the all-time low to the recent peak in yields. And if we did a Fibonacci retracement, we would say the 50% is where we are. But if we go a little further, that would be the 61.8% retracement. That's a huge level in all technical charts. And that level is 2.05%.
So how does that leave us for the 2-year then? So if that's maybe the trajectory for the 10-year, where does the 2-year go?
2 years going even lower. So in our technical view, the weekly chart of U.S. 2-year Treasury yield has a very nice, solidified, confirmed head and shoulders top in yields, right? That full downside measure is about 1.78%. Right? So the 2-year should continue to rally and thus yields fall and should move below 2% probably this year. Now, to illustrate that, we could look at the chart of bonds versus copper, if you like, because it just ties in what's happening across asset classes, right? In this particular chart here, we look at the Bloomberg Dollar Index versus the Commodities Index. I believe that's on the bottom. And on the top is bond prices versus commodity prices. Bond prices versus copper prices. And just last week, in the latest bond market rally, the ratio of bonds versus copper rallied to a new almost 3-year high. Right? So bond prices are outperforming copper prices. That's a trend, folks. 3-year highs. We hear people talk about 52-week new highs, right? This isn't just a 52-week high. This is a bullish bonds, bearish copper breakout.